Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to share today's topic with you. As we enter a new period in the market, it's essential to take a step back and assess the current landscape. Recently, Gautam Shah, an expert in the field, shared his insights on the market setup, earnings growth, and valuations. According to him, the Indian market has delivered strong earnings growth of around 20% CAGR till H1 FY 2025, driven by volume recovery, premiumization, margin expansion, and balance sheet improvement in banks. However, he expects earnings growth to normalize to around 9–10%, in line with nominal GDP. This reset of market expectations is reflected in the current consolidation phase, as investors reassess valuations amidst global uncertainties, including trade issues, monetary policy shifts, and geopolitical tensions. Now, some foreign investors have expressed concerns that the market is still expensive and that earnings growth is yet to justify PE multiples. But, as Gautam Shah points out, it's essential to consider the perspective of domestic investors, who are more comfortable with large-cap valuations and are getting more comfortable with mid- and small-cap valuations post the one-year consolidation. As we navigate this complex environment, it's crucial to maintain a balanced and diversified portfolio with a long-term bias towards equities. Investors should stay disciplined, adhering to their long-term investment plan through market cycles and focusing on fundamentals rather than reacting to short-term volatility. In conclusion, as we enter this new period in the market, it's essential to be pragmatic and disciplined in our approach to asset allocation. By doing so, we can make informed decisions that align with our investment goals and risk tolerance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone, where we delve into the world of high finance and emerge with a deeper understanding of the market's twists and turns. Today, we're going to talk about a story that's been making waves in the financial sector: Goldman Sachs' acquisition of Industry Ventures, a multi-stage investment firm with a whopping $7 billion in assets under management. Now, you might be wondering what this means for the market, and more importantly, what it means for your wallet. Well, let me tell you, my friends, this is a significant move by Goldman Sachs. The company has agreed to pay $665 million in cash and equity, plus an additional $300 million tied to performance. That's a total of $965 million, which is no small change. But what's interesting here is that Goldman Sachs is not just buying a company, it's buying a piece of the venture capital pie. Industry Ventures has a reputation for being one of the leading venture capital firms out there, with investments in some of the hottest startups around. This acquisition gives Goldman Sachs access to a whole new world of investment opportunities and potentially a significant boost to its bottom line. Now, I know what you're thinking, Lewis. This all sounds very exciting, but what about the risks? My friends, that's where things get interesting. You see, venture capital is a high-risk, high-reward game. These startups can either make it big or go bust, and Goldman Sachs will be taking on that risk. But, as we all know, no risk, no reward. And speaking of rewards, let's talk about Goldman Sachs' third-quarter earnings, which were released today. The company reported a profit of 11 per share, beating analyst expectations. Revenue came in at $14.1 billion, also ahead of expectations. It seems like Goldman Sachs is doing something right, and this acquisition could be the icing on the cake. But, as I always say, the more things change, the more they stay the same. The market is still volatile, and there are risks lurking around every corner. So, it's essential to keep a level head and not get too caught up in the excitement of it all. In conclusion, Goldman Sachs' acquisition of Industry Ventures is a significant move that could have far-reaching implications for the financial sector. While there are risks involved, the potential rewards are substantial. As always, we'll be keeping a close eye on this story and bringing you updates as more information becomes available. Stay tuned for our final story of the day, right here on the Riskwiser Zone, where we'll be discussing the latest developments in the world of finance and what they mean for your investments. Don't panic, and remember, a correction is when you lose money, a bear market is when I lose money. We'll be back after this break. Welcome back to the Riskwiser Zone. We're closing out today's show with a fascinating story that's making waves in the tech industry. You might have heard about the recent partnership between OpenAI and Broadcom, which sent shares of the chipmaker soaring. But what's really going on behind the scenes? According to reports, OpenAI has been working with Broadcom for 18 months to develop custom chips that will power its artificial intelligence systems. This deal is a big win for Broadcom, which has seen its stock price rise by 40% this year alone. But here's the interesting part. OpenAI's CEO, Sam Altman, says that the company is rethinking technology from the ground up, starting with transistors and going all the way up to how users interact with ChatGPT. Now, some analysts are speculating that this partnership could be a game changer for both companies. By developing custom chips, OpenAI hopes to bring down its costs and improve performance. And for Broadcom, this deal represents a major opportunity to expand its reach into the rapidly growing AI market. But not everyone is convinced that this partnership is a slam dunk. Some experts are warning that the development of custom chips is a complex and time-consuming process, and it's unclear whether OpenAI will be able to deliver on its promises. Additionally, there are concerns about the environmental impact of building out massive data centers to support AI systems. It's also worth noting that Charlie Kawwas, president of Broadcom's semiconductor group, recently revealed that OpenAI is not the mysterious 10 billion customer that the company announced during its earnings call in September. This has raised some eyebrows among investors and analysts who are trying to figure out what this means for Broadcom's future prospects. So, what does it all mean? Well, as always, the truth is complex and multifaceted. While this partnership between OpenAI and Broadcom represents an exciting opportunity for innovation and growth, it also comes with its own set of risks and challenges. As investors, it's essential to approach this story with a critical eye and consider multiple perspectives before making any decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.